Good afternoon, all. It's great to be here. Very happy and very proud to finally see this event coming through. So thank you to all the teams that made happen this event, and also thank you all for being here today. Thank you for being here and discuss about global equities. Today, we early in the morning had a great talk about. We started with a master class from Paulo Leme regarding what would be the outlook for the next 10 years in terms of asset allocation. We discussed also with Thomas about the geopolitical environment, how it's impacting equities, how it's impacting the market. And then we also had a talk with Tiago about how AI is driving returns and impacting the whole market. And to discuss about the global equities, and we're going to mainly discuss the same topics, but from the global equities perspective. I'm here with Nathan and Nick, so thank you for making the effort. I know that you had a lot of issues on your flight to be here, so we do really appreciate your participation today. And just for starters, I'm gonna divide the conversation in a few blocks, and we're gonna start with AI. But just before we do that, please, if you could introduce yourselves in a minute, and then we move to the first block.
Hi, everyone. My name's Nathan Achinsky. I've worked at BlackRock my entire career since 2009, and I've worked with equity investors on the long-only side across styles, market caps, you name it. And so excited to be here, and I'll turn it over to Nick.
Hi, Nick Angelosi, also excited to be here. I'm just happy to be here in general because I feel like I lived 3 lives today. I had a lot of flight trouble. I've been at JP Morgan for 15 years. Now, this is my 15th year. I spent my entire tenure at JP Morgan within our U.S. equities business as an investment specialist supporting our growth strategies. So U.S. growth you may be familiar with, U.S. tech fund you may be familiar with. So these are the conversations that we're having every day as well.
Great. So to start the first block, it would be impossible not to discuss global equities without talking about AI. So I'd like to start with that, actually. And previous conversations early this morning, we've seen massive capex. We're seeing rising demand for more and more returns on AI, and also a strong performance of a small group of companies driving the market. And the common question, of course, I'm pretty sure you've answered several times already, but would be great to hear you about whether is this current scenario a structural, or do you think it's just structural transformation, or signs? Do you see signs of excess? What's your perspective on DEI, and how do you see this rally in global equities? So Nathan, if you could start, and then Nick.
Sure, happy to. So we very much believe that this is a structural shift within the real economy, and it's happening across several different dimensions simultaneously, whether it be infrastructure and power, of course, the data center investments in terms of GPUs and memory and storage and so forth. And then what we expect to see is this to bleed through to productivity in the years ahead. Now, the question around AI and bubble fears, I always like to bring maybe new facts to the table, interesting data points to enlighten folks on what's going on under the hood of the market. First and foremost, when we look at AI adoption rates as a percentage of the US population, it took about 2.5 years to have 50% of the population using Gen AI. Compare that to the PC, it was about 15 years. Compare that to the internet, it was about 10 years. So the pace of change, the pace of adoption is incredibly fast. And then we see that as well on the revenue side. And so if we compare some of the large internet companies, some of the large public cloud players to the 2 largest private AI companies, and the revenue inflection after they first hit that $1 billion revenue year, staggering the pace that Gen AI is being adopted. 2022, we saw $1 billion in revenue on the Gen AI side. In 2025, it was over 40 billion. Expectations are for over 80 billion in 2026. The last point I'll make, and I'm sure Nick can add in a ton of areas, when we model out the economics of buying a GPU, placing it in a data center, and then earning a return on that investment, what we've concluded is, generally speaking, your free cash flow break even about year 3 or 4, the IRR over a 5 or 6 year period is fairly attractive. So the staggering degree of investment is uncomfortable. It's a natural pace of change, making that investment up front and then waiting for the returns to come. So we're still constructive on AI. We think you need to be more selective, but we're not in the camp that it's a bubble today.
I agree with that. Look, we kind of frame this in a debate between the East Coast and the West Coast, right? The East Coast is where a lot of the pools of investment capital sit, right? A lot of the portfolio managers, a lot of investors sit on the East Coast. A lot of them are in New York. And the inventors, the technologists that run these tech companies that have a vision and have a line of sight into what they're building and how capable it will be, right? That's the debate, the East Coast versus West Coast, the inventors versus the investors. Because the inventors are the ones spending all the money. You see the big CapEx numbers that they keep getting bigger every year. And on the East Coast, you have the investors saying, that's great, you're spending a lot. And maybe there's some inflection happening, but where's the return? Where's the positive return? Because I think you can make a case, depending on how nuanced that it's happening, or does the market get impatient with the amount of money that's being spent? I do think it's a structural shift, right? We've never seen this kind of scale of investment before. I think there's lots of historical parallels you can draw. My favorite is the Apollo space program, where in the 70s the U.S. put a few gentlemen on the moon, and they spent about $250 billion to do that in the 70s. And this year alone, we're going to spend 2 Apollo space programs, actually more than that, maybe 2.5, something like that. We're not putting more men on the moon right now. We're doing something absolutely crazy with technology, but I think I agree with Nathan's point. It's still very early in the inflection and fundamentals for a lot of companies that are benefiting from it. But I do think it's a structural shift.
Nice. And Nathan, well, maybe it's too early to say that, but I'll take the risk. Where are you seeing the next wave of AI shift and opportunities across sectors, geographies, and how you mentioned the word selectivity before? So how important is is the stock selection for this wave, and what could you bring for us?
I love this question, and one of the big themes for my investment teams to start 2026 is the market broadening. And we think the broadening of the AI trade outside of traditional tech areas is the tip of the spear as we look out the next couple of years. I do want to make a quick tangent towards the broader market. The S&P 500 is no longer broad and diversified. The top 10 stocks are 40% of the index. That has tremendous implications for us as investors, as portfolio builders, et cetera. And so under the hood of the market from an earnings standpoint, we're seeing that S&P 493, strip out the Mag 7, begin to see earnings accelerate. That took place in the back half of 25. It's occurring year to date. And so we're really excited by that theme. You can buy a $250 billion market cap company, and it's 30 bips in the S&P 500. So taking more tracking error relative to an index exposure, we think offers a lot of alpha opportunity. And then specific to the AI piece, we think this is a theme that will permeate across sectors and industries, industrials, financials, healthcare, you name it. A lot of sectors where there's knowledge capital, there's efficiencies to be gained. In our portfolios that we manage, we're looking at logistics companies. Think of a healthcare distributor. Think of companies that tie into industrial distribution. Even pest control is one of our theories where AI could drive efficiencies, better margins, better returns. I'll leave you with this. We can look at this data from the bottom up at the stock-specific level, but we also try and quantify it more systematically. When we look at S&P 500 companies, and we set up screens to look for businesses increasing margins, but then also communicating very specific, tangible applications of AI. For Q24, we identified about 46 companies. This latest quarter, we're at 109. So the investment is ongoing, the use cases are yet to come, and we think businesses that can get it right stand to increase their competitive advantages and drive outsized returns.
Yeah, just to add to that too, There's still an opportunity to benefit from owning stocks in the companies that are receiving a lot of the right, as the CapEx budgets go up for a lot of these big tech companies, they're still spending a lot of money. We're always trying to be mindful of where the bottlenecks might be, right? If you're thinking about building a very AI purpose data center, you have to think about what you're using in memory componentry, or the kind of networking solutions you're using to connect chips to chips, server to servers, or data centers to data centers. Or power management within the data center, within the server rack, right? There's lots of these bottlenecks that we think a lot about, and oftentimes they come in the form of companies that are not mega cap, right? So there are still opportunities to benefit from the investment and build out of AI infrastructure. But I think, to the heart of your question, who else benefits from this? I think there's a lot of great historical analogies you can draw. Who won the internet era? I mean, the internet broadband here in the US, you had many, many miles of broadband fiber optic cable put in the ground. By the way, by the early 2000s, only about 7% of it was being used. It was not utilized that much in the late 90s and early 2000s. That was maybe in part a risk, right? You had the telecom companies, the telecom equipment companies, sort of in bed with one another to keep things going. They bought and sold from each other. They put a lot of fiber optic cable in the ground with hopes and dreams that businesses would come and build on top of it. And it took a very long time for that internet broadband to get used, but it did. Look at Alphabet with search. Look at Amazon with e-commerce. Look at Meta for Facebook. Look at Netflix. Look at Uber. Right? How many companies are now using up? I mean, maybe in hindsight, we didn't put enough broadband in the ground. But what won the internet era wasn't the telecom companies. In fact, a lot of them actually went bankrupt, or the ones that survived almost hit zero but didn't quite go bankrupt. But it was the companies that I just mentioned, right? It was Amazon, Alphabet, it was Meta, it was Netflix. The companies that built businesses on top of, at the time, what was a very transformative technology. And I think if we're playing the long game here, I think there's going to be opportunities to invest in companies that aren't necessarily putting hundreds of billions in CapEx in the ground, but will end up using the technology that gets built and trained and inferenced to build a fantastic business. When we think about tech investing, there's the history of tech investing is one of leadership shifts over time, right? And at the end of the 80s or the 90s or the 2000s, 2010s, et cetera, in each of these decades were marked by a different shift in platform compute, right? We went from mainframe to PC to internet to mobile, et cetera. It was different companies that ended up becoming the big dominant winners over time. And so we're always thinking about, where we stand today, what do the 2030s look like? And we have to be open-minded. We have to have humility to the idea that leadership could look very different. It could end up being a different set of companies we're sitting here talking about in the next 5 to 10 years that end up being incredibly dominant, that won the AI era. It could also be the big mega caps today. Mind you, I think the difference being, the telecom companies in the 90s didn't actually build businesses on the internet themselves. Right? Maybe that's the break in the historical parallel here, is you have some of the biggest CapEx investors building businesses on top of generative AI, like what Meta might be doing or what Google might be doing for search. But I think as we look beyond tech, because tech companies are always very good adopters of new technologies, but I think every sector, you're going to see companies over time that win in their particular market because they were just better adopters of technology than anyone else within their respective market. So there's companies that we're looking at in insurance, for example, or even medtech within oncology diagnostics that are leveraging AI in really unique ways, but they're not AI companies.
Just to add to your question, Nick, in the previous cycles, we've seen a recurring risk that was basically the gap between investing and monetizing. How do you see, and what signs are you monitoring to track these companies as you're mentioning?
Yeah, it's a good question. I think, well, first and foremost, we're watching CapEx budgets, right? And again, I think this year alone, the 5 major hyperscalers, the biggest ones, are going to spend an aggregate of over $600 billion, and that's multiples larger than it was just 2 to 3 years ago. So we're, of course, watching that. Now, up until this point, most of that investment was was funded with free cash flow from these underlying businesses because they are some of the most free cash flow generative companies in the market. Now, of course, you're seeing some of them take on some debt. I think the session before us kind of hit on that kind of debt issuance. Look, which also means for us as equity investors, we have to be mindful of what credit spreads are doing for those that have debt, because the equity is going to have some correlation to what credit spreads are doing or what the CDS is trading at for these companies. So yeah, we have to look at that as well. We're being mindful of that. We're looking at the revenues that are generated on this, as Nathan said. Right, some of these big tech companies are already doing pretty phenomenal things with the technology. Some of the major frontier labs that are building these large language models are seeing just an absolutely incredible inflection in their revenue, the likes of which I don't think we've ever seen before. You know, going from 14 billion of annualized recurring revenue to 19 billion in just a month is pretty wild. So you're seeing a lot of inflection in revenues, and that speaks to the increasing users and increasing level of usage that these companies are seeing with that model, and that's driving obviously more demand for more compute. That's kind of how the value chain goes. So we're watching revenues there. I think frankly we still have to see more from other companies, especially in parts of software, for example, where I don't think they've done a great job generating a meaningful acceleration in revenue with Gen AI based products and features. So I think that's the sort of thing that the market still needs to see. So we're watching, again, CapEx, we're watching revenues, we're watching productivity. You know, these models are getting smarter. There are companies out there that track the capabilities of these models. They're basically doubling in what they can do every 6 to 7 months. So the capabilities keep getting better, but frankly, they have to keep going, right? I don't think these AI companies can just stop where they are. Right, they can serve us the models and generate revenue with inference, but they have to keep investing in the next frontier, the next iteration of a large language model. They have to keep getting better for other folks to continue adopting them and using them in new ways.
Nathan, do you track anything different or to complement on that?
Yeah, we're quite well aligned with what Nick laid out, and you know, maybe just one point I would add is, and you alluded to this, it's the bottlenecks. It's when you build a data center, you've got effectively two options to power that data center today in the US. You can plug into the regional power grid, or you can use, for the most part, natural gas and, you know, BYOP, build your own power. It takes over 4 years for new data centers to be plugged into the average utilities power grid. So the bottleneck piece, as we get along into 27, into 28, and so forth, we'll continue to solve for. And I think there's solutions to that, but it is something to be mindful of outside of just the revenues and the CapEx and the adoption rate.
Great. I would like to talk about sector positioning. You started talking about broadening the market, and Nick, you mentioned about a few sectors that have been doing well currently. We've seen energies. We heard today about industrials doing well, performing strongly, and while other sectors struggle to keep pace. And in the current environment, when you look into different sectors, which ones do you think are better prepared for the next phase of the cycle?
Sure, I'll take it first. So two sectors I'll highlight. One is industrials, the other is healthcare. In industrials, from a top-down perspective, when we look at manufacturing PMIs in the US, we had a prolonged period where this index was below 50. It's a diffusion index. If you're above 50, you're expansionary. If you're below 50, you're contractionary. For the most part, from 2022 through 2025, we were in a contractionary state with the PMIs. That's the longest stretch going back to the 1980s. We've seen an inflection year to date. They've moved sharply positive. Of course, AI and the data center build out is part of that. I would also posit that reshoring, you know, out of COVID is something that continues to take place here domestically. It's companies diversifying their supply chains. It's the US government wanting companies to bring critical technology and infrastructure back to the US. And so we see that when we look at GDP growth in 2025. Yes, consumption is the biggest driver of GDP growth, but non-residential investment quietly spiked higher over the course of last year and was a much, much bigger contributor to the growth that we've seen in the US economy. So we're constructive on industrials. There's a lot of ways to play that. There's secular growth in aerospace and defense. There's certainly ways within the AI trade, whether it be HVAC or liquid cooling or the infrastructure plays that are available. A lot of different options for portfolios. And then healthcare, I'll hit it fairly quickly. This sector has a trifecta of long-term secular growth tailwinds. We spend more on healthcare as we age, and we're graying as a society globally. The valuations are fairly reasonable. We're seeing innovation across a number of different areas. And so it's a sector today where you can get some stability in your portfolio. You don't have to overpay for it. And we think you'll see that nice, attractive compounding of earnings over a 3 to 5 year period.
So my answer is going to be similar, but I'm going to approach it a different way. Look, for the U.S. Growth Fund, our approach to this is less of starting with sectors. We're not top down in our views, so to speak. We're bottom up, and we're very fundamentally driven. And our process is very much about identifying bottom up opportunities where we believe there is a disconnect between fundamentals and expectations, right? So our assessment of what a company is fundamentally capable of achieving and what our perception of the market's expectations are. Right? That is the disconnect that we're trying to arbitrage through bottom-up stock selection. And we're trying to always think about what leadership is going to look like in the future. I kind of alluded to this today in terms of tech investing, but just broader market, we're always trying to align the portfolio with leadership, the cohort of companies that end up being outsized drivers of returns over time, and because it's not static, it can evolve. And to your point, markets are broadening. This year is not the kind of year it has been the last 2 or 3 years for the tech sector, but there are other sectors that have done much better. Industrials and energy, I think, is a good place to start. You know, in the last 20 years, we've seen little to no growth in demand for new power generation in this country, but there are green shoots. People are driving more Teslas, more EVs. People are using electricity in their homes in new ways for heating or cooking. But importantly, yeah, the topic du jour, we're putting a lot of data centers in the ground, or rather we're erecting a lot of data centers that are going to demand a lot more power. We weren't talking about gigawatt data centers 3 years ago, but now it's here. And that is going to place a greater strain on the power grid. And so that means absolutely there's opportunities in companies that are providing trained labor to utilities, because utilities need to spend more money. They need to generate more power. The companies that make the turbines and other power generation equipment, there's lots of opportunities there in industrials and energy. I agree with healthcare absolutely as well. This is a fairly unloved sector the last couple of years, maybe longer than the last couple of years. You have to go back a while, maybe 10 years. The last time we saw a meaningful degree of outperformance in large cap biopharma companies. But we think there's a really good opportunity now because a lot of them have gone through a bit of an expectations reset in the market. The market has grown concerned about a patent cliff for a lot of big biopharma companies. We actually think there's some opportunities there in companies that we think not only will navigate that patent cliff, but will actually thrive on the other side of it for one reason or another, be it pipeline, be it new drug delivery mechanisms. So healthcare is another area. Healthcare, I'd put energy up there. Although I should say in the growth space we live in, it's a very small piece of the universe, so it's not that hard to have an overweight view. But healthcare for sure, parts of financials, parts of tech even, not necessarily related to the AI theme, but more industrials-focused companies that provide semiconductor components to industrials and automotive end markets that haven't done as well the last couple of years. We think there's an opportunity there as well.
Thanks. And Nathan, how are you balancing your portfolio between cyclical sectors and also growth? Do you think that you both mentioned about infrastructure, you mentioned about other sectors, industrial transformation, and do you reckon investors are underestimating these sectors, or what's your view on that and how you're balancing it?
Yep. So the investment team I work most closely with, our philosophy is earnings differentiation. So when we model out our businesses over 3 to 5 years, we want to invest in companies where our views are higher than consensus. And so it's simple, and then it can be applied flexibly across the entire US universe. So we'll own quality compounders, we'll own cyclicals, We'll own higher low quality. We'll own quote unquote value stocks or growth stocks. But when we put our portfolio together, we want it to be balanced, not only from a business model and sector standpoint, but from a factor standpoint. And so, to answer your question, I really think you need both in your portfolio today. And if you look at 2025 with the AI trade, there were AI winners in memory and storage that were single-digit PE stocks at the start of the year. There were AI winners, certainly from the growth side of the ledger and optical equipment and other, ASICs chips, et cetera. And so today is a great time to hunt for alpha in the market. And then you want to rigorously manage that factor risk to make sure that the portfolio that your clients receive, that it's idiosyncratic, that it's stock specific. That's where our edge is. And I think that's so important today, and I think it's underappreciated with the dynamic market to have that risk piece really dialed in. I'll leave it there.
So I'd like to go with beyond the US now. In the past decade, US no doubt has been the center of equity returns, and at the same time, we've been seeing like other countries and other economies with good momentum and also competitive valuation. So I'd love to hear from you guys. What's your perspective on the global opportunities, and what's the potential equity distribution? What do you think of it? What are the other economies? And if you could brief us on the overview of it.
Sure. Yeah, look, it's an interesting call to make, right? To go U.S. or non-U.S. Now, I'm going to say some things that are probably going to be a bit self-serving because our strategies in U.S. equities are going to be domestically focused, although we can invest in non-U.S. companies. Historically, it's been through owning ADRs, right, U.S. listings, where we can access those companies. And I think we've done a pretty good job of identifying, individual idiosyncratic opportunities in different parts of the world, even parts of Brazil, where we've gotten quite excited. Look, I think at the end of the day, if you think AI is going to be a consequential and transformative driver of economic value going forward, I think that really lends itself to keeping a close eye on the U.S. market, right? Despite the fact that last year, yes, but the S&P was up almost 18%. It underperformed a lot of other international markets. Look, frankly, I think that was also on the back of a prolonged period of time where the U.S. was the dominant market. Look at the weight of the U.S. and just the MSCI All World Index. It's gone up an awful lot, right? A lot of capital has flowed to these U.S. companies. And I don't think that's necessarily an accident. I think folks were voting with their dollars, right? They're voting with their feet on where they see the best earnings growth, where they see the best innovation. And I do think the U.S. Has an innovative edge when it comes to what's going on in AI. I think ultimately what this comes down to. If you believe in AI as being a huge driver, then I think that lends itself to a bet on the U.S.
From our perspective, and I work with U.S. investors as well, so I think I have some bias to the U.S. But when we look at the history, and I'll take you back to 2009, if you look at the earnings growth of U.S. companies since 2009, they increased 4x. If you do that for the MSCI ACWI ex-US index, earnings doubled. And so that's really the driver of the gap in performance we've seen over the last 15, 16 years. There's been innovation-driven earnings growth domestically here. AI certainly could be the next leg of that. And rest of world, we've seen slower growth, but the valuations are cheaper as well. And so today, I think it's a US and story versus a US or. You can go into emerging markets, and specifically some of the Asian emerging markets, and diversify the US AI trade. You can invest in Japan or parts of developed Europe, where we're seeing more diversified set of businesses that are less tech heavy in terms of index composition. And so a lot of different ways to play this, but it's certainly additive to a portfolio to have a non-US piece. And that's our view at BlackRock is you anchor with the US, we'd like the structural earnings growth behind innovation, but we're seeing acceleration in other parts of the world as well, and it can be additive to a portfolio.
It's great to hear that it's an and not over, right? I would like to move to equity outlook market and see what's your perspective on what's coming next. So for both of you, if you have to highlight one relevant factor or your top relevant factors that will shape equity markets and equity returns over the next years, what would be it rather than everything else that you already mentioned, or if you can emphasize that? And how can investors and how we can position ourselves into that for the next wave?
Sure, I'll go first. So there are a lot of mega trends or mega forces in the world that we certainly believe will be drivers of performance for markets in the years ahead. AI is front and center as one of those mega forces. For the teams that I work with, we believe that the market broadening theme will be a big driver of returns domestically in the US in the next couple of years. And so we've touched on that, a little bit. When we look outside of the market broadening theme, whether it's robotics and think robo-taxis, effectively it's a robot on wheels. If we think about longer term with quantum computing, there's a lot to be excited about, and a lot can change between now and then. And we look at markets in the last 2 weeks with war in the Middle East. I hesitate to make such a big call because markets are evolving so quickly, but AI-driven growth, a broadening of the market over the next couple of years, we think you can still find really attractive returns in the US, and you can do that and play that in a number of different ways.
So I think for the outlook, it probably depends on what your time horizon is, right? We've had some volatility here in the U.S. to start the year. I don't think we're out of the woods on that. I don't, this is going to be, in all likelihood, a more volatile year than the last couple. But look, we're very constructive on equities as an asset class. Again, we're always trying to be mindful of how leadership can evolve over time, and that's more of an, call it 1 to 2 to 3 year kind of dynamic where different types of companies end up becoming big winners, and you want to align the portfolio with that. But I think if you're thinking much longer term, I think productivity is probably one of the most important things, right? We're investing in this massive new technology platform called generative AI, and the vision from a lot of the big tech CEOs is this is going to drive a lot of productivity, especially as we go from sort of co-pilot, as a lot of companies sort of term it now, and maybe that becomes pilot over time. I think there's a lot of economic value that will get created from this, especially from the companies that adopt it and integrate it better than others. I think those are big opportunities over the long term. But I think the labor productivity piece of it is one to keep an eye on. It kind of lends itself to a debate on what's going to happen in labor markets, right? If jobs end up being displaced. Look, I think here's a provocative view on that. One is you could, let's say, lay somebody off, and if that person was making $100,000 in salary, then you've saved $100,000 in salary. But if that person ended up being a power user of these tools and ended up driving more, there's no ceiling to the economic value that one person can drive, but what you're saving if you let them go. And so I think that's an important asymmetry to keep in mind for a lot of companies going forward, especially as the technology gets much better.
As we are approaching the end of this talk, I'd like to just listen to your final messages. And again, thank you for being here today and being part of the event.
I think my final message would be, we're excited about investing in the U.S. In the medium term, I would agree with what Nick said. More volatility this year should be expected. And if you can take a long-term view in markets, take a long-term asset allocation view, that's generally what we would advise, is stick to the plan. And then, of course, as markets evolve, take advantage of volatility. Lean into volatility opportunistically. That's what we're tasked with doing as active managers, as bottom-up stock pickers. And I think as it relates to AI, it's impacting our business as well. And we're integrating it into how we do fundamental research. And it's my belief that those who can leverage AI and marry it with human intuition and judgment and foresight, that's where you can generate real alpha in the future. And we're building towards that every single day at BlackRock, and I'm sure JP Morgan is as well.
Yes, we are. Thank you, Nathan. Yeah, look, similar story, right? Focusing on bottom-up opportunities, leaning into the edge we can generate for ourselves with deep fundamental research, and we allocate a lot of resources to that, and that drives a lot of opportunities for us to generate alpha. It doesn't mean that it doesn't mean we're going to outperform every quarter or every year. I think every good active manager goes through periods where times are a little bit tough, and I think for a lot of active equity investors, it's probably been a tough, call it 12 to 18 months. For those of you who have clients invested in U.S. equities, it may not feel as good relative to other markets around the world, but I think there's an important sort of grounding principle to think about here. One is just frankly, and I'll tie it back to what I said earlier, the adoption of technology over time tends to be much more linear and upward trending over time, even though we live in a world where I think sentiment oscillates between sort of two ends of a spectrum, right? Tech is a bubble or tech is dead, or equities are a bubble or U.S. equity market is dead. The reality that we live in is oftentimes right down the middle and much more steady in terms of the trends that we see for these companies over time. There are a lot of really big mega trends that could drive markets going forward, but I think to Nathan's point, having a deep, fundamentally dedicated research team that can uncover those opportunities, because I think there's always going to be winners and losers, is really, really important.
All right. Muito obrigado, Nathan. Muito obrigado, Nick. Thank you for being here. Thank you, guys.